All right, everyone. Thanks for joining this webinar today. Of course, as many of you know, we're going to be covering OPEC plus policy. My name is Reid Ianson. I am head of macro here at Kepler. I will be hosting this webinar, and joined with me today is Amena, head of OPEC analysis here at Kepler, and Humayun, who heads our broader crude analysis. Before I hand it off to them to speak about, to go through some slides before the Q&A session, just wanted to give a quick shout out to those of you who may not be aware. We have a research product here at Kepler called Insights. All three of us work on that team. We're putting out daily notes across all the major commodities globally. And so again, much of the analysis we'll be speaking about today comes from that team. And of course, we dive deep into those topics within the platform. And so if you haven't had access to that, to Insights before, reach out to sales@kepler.com and you can check out our offering. But with that being said, I'm going to hand off to Amena here in a second. Again, about half this presentation today is going to be focused on Q&A. So if you start to think of questions as we move through the presentation part of this webinar, go ahead and put it in the Q&A, and I will circle back to it in about 20 minutes. With that being said, I'm going to hand it off to Amena to get us started.
Thank you. Thank you so much, Reid, and good morning or good afternoon to all of you. I'm really pleased to be taking part in my first Kepler webinar, and hopefully I'll navigate you a little bit and answer your questions around OPEC policy. I know the last decision taken by the group surprised many of you. I was at IE Week in London, and the talk in town was basically that OPEC was going to press that pause button on the unwinding for a fourth time. But as all things with OPEC plus policy, we don't have to take things for granted and just look at the fundamentals when it comes to supply demand. There are many drivers behind these decisions, and the decision was set in place since last year. So this is not any kind of U-turn or change in plan, and I'll take you through it now. So if we could just go to the next slide, please. As you can see from here, this is the current structure of the agreement. We have 3 layers of cuts. 8 members offering the voluntary cut of 2.2 million. And then we have another voluntary cut, which extends to the end of 2026. And then the group cut, which is the bulk of 2 million, again, until 2026. So when we talk about the unwinding of the cuts, we're really talking about that first tier layer, the 2.2 million barrels per day, which will be the unwinding process will start to take place in April. Now, this will be a gradual process. It'll be over 18 months, but as the group laid out very clearly that it would require that market conditions don't change, and if we do see any changes, they are going to pause the increments if they see fit. From the chart next to that, you can see how much each country is going to be bringing back. In addition to that, the UAE will also be receiving a revision in its baseline, which was already agreed upon last year, which is 300,000 barrels per day over an 18-month period. So this is where we are today. If we go to the next slide, please. Now, why did the group decide with the unwinding is a common question, or things people wonder about, because the expectation was that it would be paused again, given that there's a lot of supply in the market, given that prices perhaps are not at a level where a lot of OPEC countries wish they would be, that favored maybe $80 plus. So why did they start unwinding now? The main reason behind that is to keep cohesion within this group. A lot of members inside OPEC have been sitting on spare capacity for a very long time, and they've been waiting to unwind the cuts for a number of years now. So this pressure within inside the group caused them to take this decision now. In addition to this, you have a number of members like Russia, Kazakhstan, and Iraq who have been leaking some of or breaking their quotas and leaking excess supply into the market. There's a lot of frustration with this lack of compliance. So therefore, other members thought it would be unfair that you have the quota busters, and at the same time, you have members who are almost 100% compliant every single time. So this would balance things out. In addition to this, you would have the members that are overproducing prepare compensation plans, and the latest is going to be delivered to the OPEC Secretariat on the 17th of March. And these plans are going to be out in public now. They haven't been out in public for a couple of months, so we'll be able to access them and see how much is going to be compensated. In theory, I mean, if the compensation plans go ahead and are 100% implemented, then we will have a buffer against that 130K that's going to be added over the 18 months. Now, I mentioned some of the members that have been not complying. Kazakhstan in February, according to our data, was the biggest quota buster by over 200,000 barrels a day. And we're seeing efforts from Kazakhstan. They had a press conference last week. Their oil minister is going to be traveling to the US, meeting with IOC. So there is effort being made to be more compliant. Whether or not that happens, I mean, that's kind of remains to be seen. And again, another common kind of question I get asked is that how involved is Trump in all of this policy and decision making around OPEC? And I can tell you, he's not. I mean, these plans to unwind were made last year, and it's not because of a request that Trump had made to add more production that the group decided to go ahead with that. I can tell you, I mean, the group members right now are looking after their own interests, and Trump is not a factor into this equation when it comes to the unwinding of the cuts. So if we go to the next slide. The other piece of this, I mean, there's a lot of uncertainty out there. When we talk about Trump being back in office, I mean, between tariffs and sanctions, these are kind of the yin and yang forces in the market that keep pulling sentiment in different direction. And recently, sentiment has been very bearish, and we can see that impact on the price very clearly. When it comes to the possibility of further sanctions on Iran and Venezuela, I mean, we have our scenario. If that happens, we might see 500 KBD of Iranian exports being cut and around 200 KBD of Venezuelan exports being trimmed off the market. And again, this would allow OPEC to add more supply or create that space. But this, again, I mean, this factor remains to be seen, because previously, under the Biden administration, when they had promised to press sanctions and they said that they were going to be limiting Iranian exports and so on, that didn't really materialize, and implementation was really difficult. So it didn't happen. So even if there is an announcement on sanctions, the impact of the announcement needs to be assessed and how sustainable that impact is. And therefore, OPEC will take its decision based on that. But has the unwinding, the recent decision, been anything that factors the current Iranian, the threat of possibly having less Iranian barrels in the market? I can tell you again, no, that was not a factor. And it was more, I mean, they're just putting the Iranian Venezuelan sanctions in a kind of wait and see column to see how that transpires. I'll hand it over to my colleague, Hamayoun.
Thanks, Amina. So indeed, it's good that you were talking about Iran and Venezuela, and I think one of the impacts of the whole OPEC plus on one side increasing production, and on the other, Venezuela potentially seeing an impact, a strong impact on its production. So as you mentioned, the impact that we see on Venezuela is about 200,000 barrels per day decline, starting from next month, as the waiver for Chevron has not been renewed, and the company has until the beginning of April to wind down its operations in the country. So as a reminder, the company operates 5 co-JVs with the PDVSA with a total production of about 200,000 barrels per day. It's also important, that decision is also important actually for US NAFTA, which was being shipped to Venezuela as a blending component for the upgraders in Venezuela's upstream sector. So in short, the US is losing a market for its naphtha, the first thing. And second thing is with the upcoming loss of Venezuelan crude in the US market. So this primarily was going to the, I mean, actually all of it was going to the US Gulf Coast, to PAD 3. So you can see the imports of from the US Gulf Coast from different countries on the left chart. So Venezuela was supplying an average of about 250,000 barrels per day. And so with that volume being gone, it's safe to say that heavy sour market in the Americas are going to be even tighter over the next few weeks and months. And I'm saying even tighter because the prices of those type of crude have really increased over the past few weeks. So you've had, for example, crude from from Colombia, from Ecuador, rise to a 2-year high in terms of prices. Likewise, Mexico's Maya crude has also risen to a level of about -$7 per barrel compared to WTI, so a relatively high level. And with heavy sour market being even more tight, we could be in a situation where one of the resorts that the US Gulf Coast refineries have is to go after OPEC crude, and namely more medium and heavy type of crude from OPEC. So looking at US imports from the Middle East, it's mainly coming from Saudi Arabia and from Iraq. In the grades that are imported are Basra heavy, Basra medium, and Arab light mainly. But looking at the US Gulf Coast, sorry, I forgot to say that the total volume is 500 KBD from Middle East to the US on average. But looking at volumes to the US Gulf Coast, it's only about 160, 170,000 barrels per day. And actually, a lot of it, most of it is Aramco sending Arab Light to the Motiva refinery, which it actually owns. So it's not purely, I would say, a trading operation taking place there. But we could be in a situation where it becomes interesting again for US Gulf refiners to look for these type of grades from the Middle East, namely more Arab Light, maybe even Arab medium grades, and also Basra medium, Basra heavy. If you look at the prices, you look at the latest official selling prices that were announced by Aramco, that's what you can see on the right. So you compare that to the respective benchmarks across regions. Saudi crude into the US is still very expensive compared to into Europe, into Asia. It shows that to an extent, Aramco is not yet fully interested into shipping a lot more crude into the US because the price difference between Arab Light, for example, and the average sour crude index in the US is more than $5 per barrel differential. But we could be in a situation where in the next few months, if US Gulf Coast are really struggling to get access to heavy sour crude, that prices could be lowered by Aramco and SOMO into the US, and we could see more OPEC crude get into the US. We're not yet there, but we could be there in the next few months. Now moving on and coming back to the global market overview. So the decision by OPEC Plus to increase production was, to a sense, as Amena said, a bit surprising because if you look at the fundamentals, we're not in a year of strong growth in terms of demand. If you look, for example, at crude intake growth on the left-hand chart, so this is the dark blue column, it's only about 300 and slightly above 300,000 barrels per day this year. You look at products demand, it's about 850,000 barrels per day this year. And 2026 also is not looking particularly bright when it comes to demand growth globally, and especially the fact that we can't say that we have lost the engine growth when it comes to oil demand, which is China, which we see its crude intake growing by less than 100,000 barrels per day this year, and slightly above 100,000 barrels per day next year in China. So at the same time, you have still strong supply growth from non-OPEC plus countries. That's what you can see on the right. You have non-OPEC plus supply is still growing at a pace of about 800,000 barrels per day. But this is mainly focused in the Americas. So you have the US bringing about 300 KBD year on year growth. Brazil, likewise, slightly under. And then you have countries like Canada, a bit less than 200. Guyana, a bit less than 70 KBD because they have the next FPSO only coming online around September. So that growth is mainly going to take place in the Americas. Whilst in the east of Suez in Asia, it's mainly going to be linked to OPEC plus countries. And so right now we see OPEC plus increasing production on average through the year by about 250,000 barrels per day. This doesn't include the exempt countries, Iran, Libya, Venezuela, and Mexico. If you add these countries, we actually see OPEC plus production year on year as decreasing year on year in 2025. But I guess the key point here is what happens next year in 2026, as non-OPEC plus supply growth is really going to be slowing down very significantly into the next year. So we actually see US production from shale basins as peaking later this year. And likewise, the high decline rates in Brazil prevent strong growth from next year onwards. So we actually see Brazil continuing to grow, but less than 100 KBD next year. And so beyond 2025, the main long-term growth story that remains is really Guyana. But that will be obviously step by step as you have about one new FPSO being brought online every couple of years or every 2-3 years in the country. So what this means for balances and markets, and we can take a look at that on the last slide that we have. Thanks, Reed. So looking at balances, we've been in a year where the first half net length has been relatively strong when compared with the previous years. And because of that OPEC plus decision, we think it is going to continue to be the case over the next 2-3 months, especially that you have refinery maintenance season hitting its peak in May in Asia. It's going to hit its peak in Europe in the next 4 weeks. And so looking at Asia only, it's about almost 3.5 million barrels per day of refining capacity that will be offline, that will get offline. So we expect the market to look relatively weak in terms of supply and demand balances between April and May. But obviously, as we get into the summer and with summer peak season, the balances will tighten significantly over the summer. And we'll reach to a point where it's not going to be as tight as it was 2 years ago, but we still think we're going to have a tight summer, despite the fact that you have OPEC plus increasing production. That again mainly relies on the assumption that we think Venezuelan production is going to be declining by 200 KBD from next month onwards. And also we think Iranian supply is also going to be declining, as Amena said, by about 500,000 barrels per day, especially starting to take place from the summer. So it means that if you look at prices, that's the right chart, we think we're still going to remain range bound between $70-$75 per barrel for most of the next 12 months on Brent. As you can see, so this is the dark blue line, which is our latest forecast. You can see that we still expect the tight summer to lift prices to around $75 per barrel for Brent over the peak summer month. But as you can see here, the downside remains also limited. So again, you have the upside limited by probably that OPEC plus decision, but also by the decisions taking and announcements by the Trump administration, as could be weighing on sentiment. Whenever prices usually shoot, you could see easily a tweet from Donald Trump then weighing on sentiment again, pushing prices down. But the downside, we think, also going to be limited by other factors, such as the inventory situation. And this is what you can see in the middle chart. You have here in the middle chart, you can see onshore oil storage globally in billion barrels. And you can easily see with the red line that we're very much under where we were over the past 3-4 years. There are plans also from the Trump administration to refill the strategic petroleum reserves in the US. It's going to be very costly. It's going to be very time-consuming. It's probably going to take years to refill the SPRs to the levels they were before 2022, if ever, even though that is the goal stated by the Trump administration. But we should be expecting, the next mandates for SPR sales to probably be cancelled. And so we should be in a situation where low inventories play a role in supporting prices, and you have prices that wouldn't drop to such a level, because if they do, then you'd have the US starting to refill its SPRs, but also other places such as China also looking to refill some of their strategic reserves. So all in all, the OPEC Plus decision obviously is having a role in shaping the oil price over the next 12 months. As you can see, our view differs from our view in the month prior. But the impact, surprisingly or not, is actually not that huge. And I would finish by saying, Amena said that the decision making still remains quite flexible. We still believe that whenever will be needed, the group will be able to pause for 1 month or more its decision making. It's increasing its production hikes to balance markets further. But to conclude, the decision will not probably trigger a full crash of prices and fundamentals, and will actually be able to support market stability over the longer term.
All right, awesome. Thanks for that, Hamayoun. We're going to move over to some Q&A now. And so I will hand this first question off to Amena, getting a lot of questions about, what do you think OPEC's next move will be? Kind of what's driving their decision making right now? Do you think that they'll pause the current unwinding anytime soon? What are your expectations around that?
Yeah, any decision around policy, I mean, they clearly stated it would have to depend on where the market takes us. I would say a main driver in the group's decision remains this idea of having cohesion. Without cohesion within the group, the whole thing falls apart. So they'll make sure that everybody's on board, everyone is happy with the policy, and that's what really will continue to shape policy looking forward. I see them, I mean, they will unwind the cuts in Q2. That's the plan. We have the summer coming up, where traditionally, I mean, you have demand rising during that period, which will help support these increments. And as I mentioned before, I mean, with these compensation cuts, Reid, I mean, that should kind of neutralize any impact. We're talking about a drop in the bucket here, 130K. So if you factor in the compensation, it will be almost zero coming into the market. But the market works in different ways now. It's not really focused so much on the fundamentals. And if you look at stock levels, for example, they're really tight. Even Chinese, Hamayoun can go through the numbers here on how much Chinese stocks are dropping. And this is something that we're looking at. But it's more around sentiment. And that remains very, very volatile.
Okay, awesome. And actually, probably to build on that point that you've made, Amena, maybe Hamayoun, hand this off to you to maybe speak about our expectations for price through the rest of this year. And also, the market right now seems somewhat bearish, and yet we have seen onshore inventory levels globally look pretty depressed. Do you have some thoughts around kind of the divergence of those two things?
Yeah, of course. I think, when you look at the latest action in prices in physical markets, especially within the past 2-3 months, with backwardation really having strengthened, especially in Asia, that obviously didn't incentivize storage levels in onshore Asia, especially in the countries like China. So we have that backwardation kind of normalizing. I would say probably went way too far. You had the Dubai 3-month spread shoot over $5 per barrel on expectations that maybe you could see a lot less Russian crude hit the market after the latest Biden sanctions on Russian tankers. it hasn't really materialized. We still see, sanctioned tankers actually being able to continue deliver Russian crude into Chinese ports. We have seen a lot more non-sanctioned tankers enter that business as well, of moving especially Eastern Russian crude into Chinese ports. So all in all, the impact on Russian crude exports into Asia has been relatively minimal, little. We have seen a bit of an impact. They have decreased slightly, about 100, 150 kbd. But it also has to do with the domestic situation in Russia with, peak winter, you had strong demand in Russia. So we should be in a situation where actually this rebounds, the level of exports from Russia over the next few weeks and months. And that should be further, reducing that backwardation that we are having right now in the Asian market, supporting probably, the reasoning for building inventories over the next few weeks. On top of that, you have peak refinery maintenance season in Asia in a few weeks' time, in 2 months. And so that should be pushing inventories up as well. So all in all, this I think will mean that markets will be less tight over the next 2 months, really, before actually seasonality kicks and you have another kind of tightening happening, because a lot of those refineries will rush and start buying strongly again after coming back from maintenance.
Okay. Awesome. Let's actually stay on the price conversation, and I want to hand this back off to Amena. Getting a lot of questions around, is there a minimum price level where maybe OPEC would feel that they need to bring back cuts or at least pause the unwinding cycle? Do you have a range that you would expect? So maybe just speak on how OPEC is thinking about the price situation right now globally.
Yeah, this has been kind of the talk of everyone since OPEC was, founded. What is the red line for prices? And just given the number of members of this group, there isn't kind of a united front of we need to target this price. And I can tell you very clearly that targeting prices doesn't work as a market policy, and that's why they always make sure to say that they're balancing supply demand fundamentals rather than targeting prices, which if you say, I want a price of 90, the market is never going to give you a price of 90. So targeting prices is just not something that OPEC Plus does. Is there a favorable range by each state? Sure. Yeah, there is. There is a break-even price. I mean, maybe for some of the Gulf states, for Saudi Arabia, for example, they would like to see 75 to 80. But at the same time, I mean, the Saudi budget is so flexible. When they put it together, they don't look at just one range. They look at maybe 3, 4 sets of ranges, and then they can adapt to something. Maybe producers get a little bit nervous with prices going under that $70 mark, but it depends on how long it stays there, so how sustainable it is, and if it slides further. Of course, if you tell me, I mean, I was just having a meeting today here in Dubai, and someone was saying, okay, a scenario of $50, but we need to see what caused the $50. Is it a weakness in the economy? Because if we do have another, God forbid, COVID situation, yes, I do see the group coming together again and putting together a plan that would help support oil demand in the future, perhaps introducing new cuts. So for that question, Reid, I would say that, yeah, no specific price.
Got it. And Amena, I'll stay with you. Let's shift now to speaking a little bit about Trump. I think we have to speak about
Everyone's favorite topic. Yeah.
Indeed,
Trump.
indeed, yeah. Quite a number of questions around tariffs and what all that could look like. But Trump actually recently said that he is interested in visiting Saudi soon. What does that imply for Saudi oil policy? How is he going to play a role in that moving forward?
It doesn't work like that. I know that there's a simplistic approach where everyone thinks that Trump lands in Riyadh or Jeddah and tells, the officials there, I want this, I want that. It doesn't work like that. I think we've moved on from the point where the US provides security for the Gulf states and they provide oil. That relationship has evolved. I'm not saying that it doesn't exist entirely, but it's evolved from that. And if the US right now puts its priority, and Trump made it clear that he wants to make America great again, Saudi wants to make Saudi Arabia great again, and the UAE wants to make the UAE great again, meaning that all of these OPEC producers are putting their own national priorities first and not just following what Trump wants, regardless. So in the input that Trump has on policy, therefore, I'm not saying it's not a one-to-one relationship at all. Again, it's not the first time that Trump visited Saudi as a first country. He's done that in 2017. He says he's going to do it again. And this has a lot to do with investment, Reid. I mean, Saudi Arabia has Vision 2030. There's a lot of diversification going around. A lot of American companies want to do business in Saudi and vice versa. Trump is clearly he wasn't blunt about it, and he's seeking a lot of investment from Saudi Arabia into the US.
Got it. Got it. And let's stay with the Trump theme and just kind of shifting to views on Iran. Someone asking here, how serious is Trump in reaching a nuclear deal with Iran, and what would that mean in terms of sanctions? Amena, we'll stay with you on this one.
Sure. I mean, it's kind of been mixed. He's been yo-yoing a lot. I mean, we did get that announcement of I will impose maximum pressure on Iran. I will have their exports down to zero. And then you hear other news that he is reaching out to Russia to mediate a nuclear deal with Iran, and he wants to reach an agreement and so on. It's really hard. I mean, Hamayoun can pitch in on this as well. It's really hard to tell how things will transpire, but it comes down to the Chinese buying Iranian barrels. And what we can see is that, sure, the Chinese government can impose some limitations on Iranian vessels coming into certain ports, but how are you going to stop the teapots from buying? So we're in a different situation here, and bringing exports down to zero just doesn't make sense. Hamayoun?
If I could just chip in, yeah, absolutely. I think the key here on this issue is going to be China, to an extent Russia as well, and the potential resolution of the conflict in Ukraine could push Russia to broker a deal as well between Iran and the US. But I think at the end it comes down to China. And it's really down to what you think will happen between the US and China. China probably would not want to be bullied into reducing its purchase of Iranian crude, even though it's not really the state-owned companies that buy Iranian crude, it's really the teapots. But there are ways that the state can play around this, and obviously the state in China knows that this is happening. So potentially, if you think that the US and China will start discussing more seriously in the next few weeks, you could be in a situation where you believe that the Chinese state will not give up Iran, but to an extent will ask its own teapot refiners to reduce their buying. Generally saying, though, the US has been strengthening its sanctions on the tanker market, tankers moving Iranian oil. There's still about a big chunk of tankers still waiting to be sanctioned, if I could say so. But we know for a fact that it has become more complicated for Iran to move its crude. It's doable. It's not impossible. We've seen exports show a big rebound in February to almost an all-time high on a monthly level, around close to 1.8 million barrels per day. So it's doable, but it's just taking more time to rework on the supply chain. But if the US really goes hard and decides to sanction a lot more tankers, then it will become very complicated for Iran and the teapots to continue that trade. And that's why we think that at some point the supply chain will be so difficult to rearrange that we think it will impact production and exports by about 500 KBD, probably around the summertime.
Got it. Awesome. Thanks for that. And obviously, I'll chime in here as the macro guy on the team. Keep in mind that one of Trump's main economic goals right now is to narrow the trade deficit. Obviously, China is running a very sizable trade surplus with the rest of the world, of which the US is a key downstream point of demand. And so it is our belief that the Trump administration will remain pretty aggressive in implementing tariffs on China uh, over the course of this year. Just a couple of weeks ago, we saw Trump actually raise his initial tariff implementation by an additional 10%. And so that the prospects that we get a quick trade deal between the United States and China, which would maybe push China to reduce its purchases of Iranian crude, uh, seem a bit more unlikely at this point. Let's go ahead and shift over. And Hamayun, I'll ask you about this. Of course, we're talking about OPEC plus policy here, but also non-OPEC is playing a role in these markets, right? Uh, and so we are getting some questions around expectations for U.S. shale. First, maybe just reiterate what our expectation for growth is this year across U.S. shale, and why we're assuming that as well.
Yeah, for sure. So this year, on a year-on-year basis, we see production growth from the US, not just shale, from the US at around 300,000 barrels per day, slightly under this level. However, when you look at it from a December to December point of view, so December 24 to December 2025, growth is already very stagnating. It's slightly growing over that period of time, and that's because you had a lot more production growth coming online at the end of last year, Q4, especially in the Permian Basin. Where this growth is coming from this year, actually, you have a lot of new production coming from the Gulf of Mexico, so not a shale basin, and actually kind of medium sour type of crude. So Gulf of Mexico is going to be increasing on a year-on-year basis by about 140,000 barrels per day. So it's almost half of the growth this year. But you obviously have decline rates hitting there as well. So looking forward after 2025, we actually see production from the US as staying flat between 25 and 27 before starting to slightly decline. As you said, I think in your question, the issue is really prices. Current prices, it's not really incentivizing a lot pickup in upstream activity.
Got it. Awesome. Thanks for that, Hamayun. All right, I'm just going to kind of run through a smattering of questions here now to kind of finish it out. We have another couple of minutes. First, just a clarification on our Iranian expectation. We think that exports will drop by 500 KBD off of a baseline around 1.5, 1.6 million barrels per day, not exports down to 500 KBD. Hamayun, am I correct on that assumption?
Yes, yeah.
Absolutely.
Yeah. All right. Some other questions just flowing through here. What does OPEC think about Kazakhstan exceeding their quota in February?
Yeah, they don't like it.
Okay.
They don't like it at all. I mean, they've made that really, really clear. I mean, to the point where Kazakhstan now needs to come up with a new mechanism, and they said they're going to be talking to the IOCs. They met the IOCs in Kazakhstan, and they have their oil minister, as I said, in this week in the US, and they have to come up with a mechanism to start cutting more, not just to their quota, no, compensating for all the extra volumes. So I see the action as being serious, but to what extent would that, be implemented? Yeah, let's wait and see. As you know, Kepler is one of the secondary sources, and we are closely monitoring what they do.
Okay, awesome. Got a question here on just the Red Sea. Any updates on that situation? Obviously, we have Kepler data tracking that. So any thoughts on that? Maybe
Yeah,
Hamayun on you, to
yeah,
you?
the levels have been very weak. I can't remember them on the top of my head, but they've been under 2 million barrels per day. I'm talking about just crude, east-west and west-east, so including Russian oil. And the reason is really because Russian oil exports have been declining through the winter. So that may explain that mainly. On the other side, you have still Saudi Arabia is still able to ship most of its crude that it ships to Ain Sokhna in Egypt and then via Europe via the Red Sea because it's able to bypass the Bab el-Mandeb Strait via its east-west pipeline. But if you look at the likes of Iraq and the UAE, who still ship some crude to Europe, to the European markets, most of their exports are actually going via the Cape of Good Hope. So for Iraq, I think it's about 70% of their exports going via the Cape of Good Hope still. And for the UAE, it's 100%, but the volumes are much lower.
Okay, awesome. All right, we're going to call it there. We're at the 40-minute mark. Thanks again, everyone, for joining this webinar, asking a lot of great questions. Again, if you haven't had access to the Insights platform, email sales@kepler.com. We can get you a trial access. And again, we are covering all of these topics in detail from day to day. But again, thanks for joining, and we'll see you next time. Bye-bye.